You've seen those retirement forum posts. Someone writes, I haven't contributed to my portfolio in over a decade, and it's worth more than it's ever been. And you assumed they were lying, or rich, or got lucky on some meme stock back in 2015. You scroll past it. You go back to your budget spreadsheet, trying to squeeze out another few $100 a month to invest. Grinding, sacrificing, white-knuckling every paycheck into a brokerage account because every financial guru on the planet has told you the same thing. You have to keep contributing, consistently, every month, rain or shine. That's the only way to build wealth. And look, that advice isn't evil. It's just incomplete. And the incomplete part? That's the part that keeps people exhausted, burned out, and feeling like they'll never have enough, no matter how hard they try. That's not a typo, because here's what nobody shows you. There is a point, a specific mathematical inflection point, where your portfolio stops needing you, where the money it generates on its own dwarfs anything you could reasonably deposit from a paycheck, where contributing another few hundred a month is like tossing a cup of water into a river and thinking you're making it flow faster. Most people never see this because they're too busy staring at their monthly contribution like it's the only thing keeping the engine running. It's not. Past a certain threshold, the engine runs itself, and it runs harder than you ever could. My name is Ben, and today we're going to mathematically destroy one of the most deeply held beliefs in personal finance. The idea that your portfolio only grows when you feed it. That the moment you stop adding money, your wealth flatlines. That contribution is the engine, and without it, you're coasting to a stop. Here's what I'm actually going to show you. A portfolio of $300,000. Not $1 million, not some trust fund number, just $300,000 can silently, without a single additional dollar deposited, transform into $1.4 million. No extra contributions, no side hustles, no inheritance landing in your lap, just time, compounding, and a principle that most people intellectually understand, but emotionally refuse to trust. The myth isn't that contributing is bad. The myth is that contributing is what matters most. It's not. And by the end of this video, you're going to understand why the people who figured this out early are the ones posting those retirement photos you keep scrolling past. Let's be fair. This myth didn't come from nowhere. There are real reasons people believe that constant contribution is the primary driver of wealth. First, every piece of financial content you've ever consumed emphasizes the input. Max out your 401k. Set up automatic deposits. Pay yourself first. The entire vocabulary of personal finance is built around the act of putting money in. Nobody makes viral content about doing absolutely nothing. That doesn't get clicks. That doesn't sell courses. Second, when you're early in your investing journey, contributions genuinely are the main event. If you have a few $1,000s invested, a decent market year gives you back a few $100. Meanwhile, you contributed 5 times that from your paycheck. So your lived experience confirms it. The deposits are doing the heavy lifting. The market returns feel like a rounding error. And third, this is the one that should make you angry. The financial industry needs you to believe that active participation equals results. Your financial advisor charging 1% a year to tell you to keep contributing? You know what his incentive is? That you keep contributing. Because his fee is tied to your total assets. He earns more when you put more in. He's selling you discipline, but what he means is his own revenue stream. Brokerages, apps, premium tiers, they all need you logging in, moving money, making decisions. A person who parks their money and walks away for 20 years is a terrible customer. They don't generate fees. They don't buy courses on options trading. So the entire ecosystem around you is whispering the same message. Your effort is what builds wealth. Your discipline, your monthly contribution, your sacrifice. And we buy it because it maps onto everything else in life. You don't get stronger without going to the gym. You don't learn a language without studying. So it feels deeply logical that your portfolio won't grow without you actively feeding it. That was just the setup. Here's what this creates. A generation of people who are incredible savers, but terrible trusters. People who've accumulated a meaningful portfolio, enough to genuinely change their life, but who live in constant anxiety because they think the moment they stop contributing, the whole thing stalls. I've seen people with substantial portfolios refuse to take a career break, refuse to drop to part-time, refuse to breathe, because they believe that pausing contributions is the same as pausing their financial future. That belief is mathematically wrong. And I don't mean slightly wrong. I mean the math is so lopsided that when you actually see it, you'll wonder why nobody showed you sooner. I call this the contribution fallacy, the belief that what you put in matters more than what's already there. And it controls more financial decisions than any interest rate, any market crash, any tax policy ever could. Let's kill it with arithmetic. Here's where it gets fun. Let's take a portfolio sitting at $300,000. That's it. That's your number. Maybe you built it over a decade of saving. Maybe you inherited some, earned some, scraped together the rest. Doesn't matter how it got there. It's parked in a diversified index fund. And starting today, you will never add another dollar. The S&P 500 has averaged roughly 10% annually over the last half century. Some years it rips up 25%. Some years it craters. But the long run average, including crashes, recessions, pandemics, and every headline that made you want to sell everything, roughly 10%. So let's apply that to your money and then do absolutely nothing. After 5 years, your portfolio has grown by almost $200,000. You didn't earn that at a job. You didn't sacrifice a single weekend. It just compounded while you were living your life. After 10 years, your money has more than doubled. You're closing in on $750,000 and you haven't lifted a finger. After 15 years, you've crossed $1 million. You're a millionaire. From a portfolio you stopped feeding a decade and a half ago. And somewhere around year 16, $1.4 million. Now here's the part that breaks people's brains. Compare this to someone who starts from zero, but contributes aggressively every single month into the same fund, same returns. After 16 years of disciplined, never miss a month grinding, their portfolio is worth roughly a third of what the person who did nothing has. The person who contributed zero for 16 years has triple the wealth of the person who hustled every single paycheck for the same period. This is the contribution fallacy in full collapse. But that's not even the expensive part. The expensive part is the decisions this fallacy causes. People stay in soul-crushing jobs because they think they can't afford to pause contributions for even a year. They delay experiences, relationships, their health, because that monthly deposit feels sacred. They optimize for income when they should be optimizing for time in market. The math says something radical. Once your portfolio reaches a critical mass, every year you leave it alone is worth more than most people deposit in 5. This isn't magic. It's exponential math. And exponential math is deeply unintuitive because our brains think in straight lines. But compounding doesn't work in straight lines. It works in curves. And the curve gets violent toward the end. Let me show you what this looks like in an actual life. Jordan is 38, works as a senior logistics coordinator for a mid-sized shipping company in Charlotte, North Carolina. Makes about $81,000 a year. Been investing since 26. Started with a couple $100 a month, bumped it up in their early 30s after a few raises. By 38, Jordan's portfolio, mix of index funds and a 401k and a Roth IRA, sits at just over $300,000. And Jordan is exhausted. Not from the job, though that's tiring too. Jordan is exhausted from the financial treadmill. Every month, budget, transfer, invest, check the balance, feel like it's not enough, repeat. Jordan's been eyeing a career shift, wants to move into nonprofit work, something that actually feels meaningful. The pay cut would be significant, maybe 20% less, and that means the monthly investment contributions would have to shrink, maybe stop entirely. Jordan's financial advisor, nice guy, means well, still wrong, said, "You really shouldn't stop contributing. Consistency is everything. This is the worst time to slow down." And his wrongness is costing Jordan a decade. So let me show you two versions of Jordan's future, because this is where it gets real. Jordan A listens to the advisor, stays in the logistics job, keeps grinding, keeps contributing $600 a month for the next 20 years, hates most of it. By 58, Jordan A's portfolio sits at roughly $2.35 million. Jordan B ignores the advisor, takes the nonprofit job at 38, loves the work, contributes nothing, not a single dollar, for 20 years. By 58, Jordan B's portfolio sits at roughly $2 million. The difference? About $350,000. Now let me reframe that number for you. That's $17,500 a year. That's the price of Jordan's freedom. 20 years of meaningful work, lower stress, better sleep, a life that actually felt like theirs, for $17,500 a year. Most people pay more than that for a car they don't even like driving. And that's the quiet part. The contribution fallacy doesn't just distort your math. It costs you years. It costs you options. It costs you the life you actually wanted to live, because you were too afraid to stop feeding a machine that was already running on its own power. So if constant contribution isn't the real engine past a certain point, what actually is? It's something so boring that no financial influencer will ever build a brand around it. No one's going viral for saying this. No one's selling a masterclass on it. Uninterrupted time in market. Not timing the market. Not time spent researching stocks. Not time on Reddit reading about what some guy thinks the Fed is going to do next quarter. The sheer, unglamorous duration that your money sits invested without you panicking and pulling it out. Compounding doesn't reward the person who contributes the most. It rewards the person who interrupts it the least. Every time you panic sell during a downturn, you don't just lose the dip. You lose the recovery. You lose the compounding on the recovery. You lose the compounding on the compounding on the recovery. The damage cascades forward in ways that make the original loss look like pocket change. I think of this as Newton's law of portfolios. A portfolio in motion stays in motion, unless acted upon by its owner. And most of the time, the owner is the only force that actually stops it. Now, I can already hear the objection. Okay, Ben, but what about the lost decade? The S&P 500 went basically nowhere from 2000 to 2010. What then? Fair. Let's talk about it. If you had $300,000 invested in January 2000, the absolute worst time to start, you rode the dot-com crash, the slow recovery, and then the 2008 financial crisis. By 2010, your portfolio was roughly back to where it started. A decade of nothing. Brutal. But here's what happened next. If you didn't touch it, didn't panic, didn't sell, didn't cut your losses, by 2024, that same $300,000 had grown to over $2.5 million. The lost decade wasn't lost. It was a loading screen. The people who quit during the loading screen missed the entire game. And that's the thing about compounding. It doesn't owe you a smooth ride. It owes you nothing on any given year or even any given decade. But over 20, 30, 40 years, it has never, not once in the history of the US market, failed to deliver. The price of admission is just sitting there. That's it. That's the whole thing. So practically, what does this mean for you? 3 things. None of them require a spreadsheet or a financial advisor charging you a percentage of assets they're barely managing. First, protect the base. Your portfolio's worst enemy isn't a market crash. It's you, pulling money out during a downturn because you panicked, or rating it for something that felt urgent but wasn't. Build a cash buffer outside your investments, enough to cover several months of life. Not because the gurus told you to, because it's the moat that protects the compounding machine. Without it, you will eventually raid the portfolio. Everyone does. Second, minimize the drag. Fees, taxes, unnecessary trades. Every percentage point you lose to expense ratios or short-term capital gains taxes is a percentage point that doesn't compound for the next 20 years. Keep your investments in low-cost index funds. Stop trading. Stop rebalancing every quarter because some article told you to. Every transaction is a potential leak in the hull of a ship that was sailing perfectly fine on its own. Third, and this is the hard one, stop checking. Seriously. We live in a culture that sells inactivity as laziness. Doing nothing with your portfolio feels like doing nothing with your life. And that's garbage. But it's profitable garbage for everyone except you. Delete the app from your home screen. Check your portfolio quarterly at most. Your compounding doesn't need your attention. It needs your absence. And that brings us back to where we started. You scrolling past that retirement forum post. The one where someone said they hadn't contributed in over a decade and their portfolio was bigger than ever. And you assumed they were lying, or lucky, or born into something you weren't. They weren't. They just understood something you didn't. Yet. The contribution fallacy told you that your wealth is built by what you deposit. That every month you're not adding money, you're falling behind. That the grind is the point. It's not. The grind gets you to critical mass. That's its job. And then, and this is the part that feels almost offensive in its simplicity, you get out of the way. So here's where you actually have to choose. You can keep doing what you've been doing. Keep white-knuckling every paycheck into your brokerage account. Keep staying in the job you've outgrown because you're terrified that pausing contributions means pausing your future. Keep optimizing the input while ignoring the engine that's already running without you. Or you can look at what you've already built, really look at it, and accept that your money might have already outgrown your paycheck. That the most valuable thing you can do for your portfolio isn't adding to it, it's leaving it alone and building a life worth having while it compounds. You can't do both. Not really. Because one path is about control, and the other is about trust. And the contribution fallacy survives because control feels productive, and trust feels reckless. But the math doesn't care what feels productive. The math has been trying to tell you something for years. Your portfolio is talking to you. It's been talking for a long time. Maybe it's time you actually listened.